Hello options traders, welcome everyone. And as many of you know in this group that I often post videos and often screenshots throughout the day just talking about different aspects of the market. And when I do, it's usually of the S&P 500, not the Dow. And I get a lot of traders asking, well, if CNBC is always talking about the Dow, all of the news sources quoting the Dow, how come you're not quoting the Dow? And it's a really good question, and it is true that the Dow is by far and away the largest and most widely watched index, but that doesn't mean it's the best. And professional traders understand the limitations and that you can get very mixed signals just by following the Dow. So yeah, we will look at it and we understand where it's trading, but if you're really trying to get good signals or good understandings of what's happening in the market, you need to be looking at the S&P 500. Otherwise, you can get very mixed signals. So for example, over in Thinkorswim, today is March 9th, 2020, so another big scare from the coronavirus. So let's zoom in here a little bit, and you can see that big red candle approaching the 1,000-day moving average, which I've talked about before, but the indication is that we're having this very large sell-off in the market if this was your view of the overall market. But watch what happens when we go to the S&P 500. So let's come up to here, and we'll do SPY, go to the spiders, and now we get a very different picture. We've got an inverted hammer, and it's green, actually pointing more to a bottom than to a big sell-off. Very different pictures between the two indexes. So what's going on here? Well, to understand why professional traders rarely look at the Dow, it's because of the way that they're calculated, and also for the fact that the Dow only has 30 stocks in it. But a lot of it is far more about the way that the calculations are done. So let's take a look at the Dow calculations. So let's take a look at a simple Dow calculation. So you have to understand that the first time this was done was back in 1896, Charles Dow. And this was obviously done by pencil and paper, not with Excel and with iPhones. Okay, so that was one of the reasons that they only looked at 30 stocks, and because it was a very tedious calculation. But just to show you very simply how it was done, let's say that we only have 3 stocks in our index. And stock number 1 closes at 100, number 2 is at 200, and number 3 is at 300. So if we were calculating our small Dow average right here, we would add those up, we get 600, we divide by 3, and we would say that the Dow is trading for 200. So a lot of people don't even understand that the Dow is actually, in a sense, the average price of a stock. Even though you might be thinking, well, hardly any stocks are anywhere near the level of the Dow, but that's because there have been so many splits. And so every time one of these stocks splits, the Dow has to make an adjustment for it. Otherwise, as you can tell, it would artificially influence the index. So for example, let's assume that our $300 stock here goes through a 2-for-1 split, and it's now trading for 150. Well, what's that going to do for our index? Well, think about it. We're now going to have 100 plus 200 plus 150, which is a total of 450. We still have 3 stocks in our index, so it's 450 divided by 3. Our new index level is 150. So it looks like our index got absolutely hammered. It fell from 200 to 150 when nothing really happened. Remember, a 2-for-1 split is like getting 2 5s for a 10. It doesn't really change anything. But yet, it really made a big impact in our index. So what could we do here? Well, this is where we have to do a little mathematical finagling to make it balance. And so rather than dividing by 3, we figure out mathematically what number we could divide by to still come up with 200. So all we have to do is to take 450 divided by 200, and that gives us 2.25. So if we divide by 2.25, guess what happens? Now we get right back to where we were. Our index is unaffected by the split, as it should be. But notice that this number in red right here, this 2.25, is kind of artificially done. It's just done to make that index balance. And then from here, if the index is up or down from supply and demand, then our $200 number right there would change. But if we go through more splits, we're going to have to continually change this divisor. So the point is that the Dow's value is absolutely calculated by the price or the values of the stocks in it. So it is what's called a price-weighted average. For that reason, it is simply the prices of the stocks in the index that count. And therefore, the highest priced stocks carry the most weight. This is one of the big kickers. Whichever stock in the index happens to be trading for the highest price is the one that can influence the entire index. So think about it, even though there's 30 stocks in the index, which isn't very big to begin with, one stock in there could be throwing the entire index to make it look like the entire market is down, when it just isn't. Now, through the years, there have obviously been many different splits, and there have been a lot of swaps. We've taken some stocks out, put some stocks in, and all of those have had influences on this divisor that I just talked about. So right now, if you want to know the actual divisor, it's this big long string of numbers right here, but let's just call it about 0.147. So if we take $1 divided by this number, it shows that each dollar move in the index accounts for about 6.78 or almost 7 Dow points. So let's jump over to an Excel spreadsheet and take a look at how it works. So here's an Excel spreadsheet that I created, and I've set it up with what are called DDE links in it that are going out and grabbing live data and importing it into the spreadsheet. So you're going to see that these numbers are going to change here every so often, and these are the 30 companies in the Dow. There you see it just changed. So here's our 30 companies, and what it's doing is it's taking the last price right here of each stock and it's adding them up. And so the sum comes up to about 35.25 now. Here's the divisor that I talked about. So if we take 35.25 divided by this number, we get 23,904, almost 905. So that's calculating it by hand. So now about 23,884. We come up here to the actual Dow, it's about 23,891. Part of the reason is that we're looking at delays by the time that these are getting pulled in versus where the Dow is trading. But you can see it's pretty close. And as I talked about before, if we take 1 divided by this number, we get almost 7 Dow points. So what does this tell us? What it means is that the stock that has the highest price is going to have the biggest influence. So think about that. Again, even though it's a small index, you could have one stock that's absolutely getting clocked. And if it's also a high price stock, it could be dragging the entire index down, which is hardly a picture of what's happening in the market. So right now, look at our 3 most valuable stocks. We got Apple at 270 roughly, Boeing at 229, and we've got United Health down here at 271. But look at the stock that's accounting for the biggest drop in the Dow. It's Boeing. It's a relatively small stock compared to the other stocks in the Dow, but it's accounting for about 228 points of that drop, just because it's a fairly high-priced stock and the Dow counts all of them equally. That is the big problem with it, is that one of these stocks in a very small index can have such a big impact. So for instance, let's go back over to TOS. And now I'm going to pull up what are called the heat maps, and we're in the Dow Jones up here. Again, you can see Walmart is the only stock that is up. But take a look at the size of the boxes in here. And the size of the box is the price times the current stock price, which is called the market cap. And the Dow doesn't account for the market cap. But take a look at this box right here in Boeing. This little rectangle. It's fairly small compared to others. Look how big Apple and Microsoft and Visa, J&J, all fairly big companies compared to Boeing if we look at it on a market cap base. But they don't. They just take it as a price base or a price-weighted index. So again, this is the big problem why professional traders rarely look at the Dow to say what is happening in the market. So how does the S&P 500 change this? Well, the S&P 500 index is what's called a market cap weighted index. And its calculation is different. It's going to account for the shares outstanding. It's going to take the price times the shares outstanding. Notice that the Dow does not do this. And it's going to divide by the total value of the SPX. So the larger the market cap, the larger the effect on the index. So let's say that a stock carries 2% of the weight in the index, and that stock is up 10% for the day. Well, then that means that SPX is going to rise 2% times 10%, or 0.2%. So even though it's having a huge day, up 10%, it's only accounting for 0.2% of the change in the index. So again, this is going to be regardless of whether it's a $10 stock or a $2,000 stock. It is simply the value of the market cap that is affecting it. So here's just a mini look at the S&P 500. I'm not going to do the entire index, but Microsoft, Apple, and Amazon carry the largest weights. So Microsoft right now trading for about 152. It has about 7.9 billion shares outstanding. So if we multiply 152 times 7.9 billion, we get this big number here of about 1.2 trillion. For Apple, trading for 269, let's call it, 5.2 billion shares outstanding, has a market cap of almost 1.4 trillion. And then finally, Amazon, trading for 1822, only has about 500 million shares outstanding. So if we multiply those numbers out, we get about $911 billion. So if we add up this entire column right here, these three numbers, we get this big number right here, about 3.5 trillion. And so this is how the S&P is calculating it. It's saying this market cap right here divided by this number is 34%. And then this number divided by the total is 40%. So if this was our entire index, these would be the weights. So notice that we don't have to account with this funky divisor that the Dow comes up with, because it's automatically included if a stock does a split, because that will change the number of shares outstanding. Stock gets cut in half, let's say, number of shares outstanding doubles, and it's a wash. So that's why the S&P doesn't have to do these strange divisors like the Dow. So if you're wondering why you can get such conflicting signals, now hopefully you understand why. Again, think about the size of the market cap, the size of these boxes are having almost relatively no effect compared to the effect that Boeing is, this small company, just because it's a very high-priced stock. But now if we go to the S&P 500, you'll see that even though you have some fairly large boxes in here, large market caps, it is accounting for that in the calculation. And then also for the fact that we have 500, actually technically about 505 tickers now, because there's B and C shares in here, but it doesn't have that much influence on the actual index. So hopefully that explains it, why whenever I'm doing these posts, I will rarely talk about the Dow and almost always talk about the S&P 500 when we're talking about the markets. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.